Morning for Incorporation Made Simple, a practical guide for small business owners. So you have two hosts today. There's myself, Alicia Lowen. I am an accountant. I'm the owner of Deximal Accounting Inc. We are a accounting firm based in BC, but we are online and paperless, so we serve clients and small businesses across Canada. And my co-host is Jaime Bell.
Hi, everyone. Thanks for joining us this morning. And right off the hop, we just want to apologize for the technical snafu on Tuesday. Happy that you showed up. And if you're watching this on the replay, we really appreciate it. And hopefully we give you some great value today. So like Alicia said, my name is Jaime Bell. I'm a business lawyer based in BC. I have a small firm where I work solely with small business owners. And then I also own the Contracts Market, which is a legal contract template shop that is for Canadian and US based entrepreneurs. So two things before we get going, I just always like to take a deep breath and say, we showed up, and that's actually really hard sometimes to make the space for this in our business. And legal and accounting is not always the sexiest thing to sit and listen and learn about, but it is a really important foundation in your business. So thank you so much for showing up. And then secondly, I am a lawyer, so I'm going to give you this disclaimer. Now, this workshop is for information educational purposes only. And while Alicia and I are lawyers and accountants, we are not your lawyers and accountants. And so if there's anything that gets flagged for you in this workshop that you're like, I need specific advice on this, then you can reach out to a lawyer or an accountant that is local to you. That might be one of us, but you'll need to hire someone in order to get specific advice. So we will be having a question period at the end of this. And while we're happy if you bring up some like specific things that you're wondering about your business, we can't give you advice on it. So you'll have to either book a call separately or find someone local to you. So with that being, sorry, go ahead, Alicia.
I was just going to say that people who are live on the webinar right now will notice that there is a chat bar on the right-hand side. So that is where we will be collecting questions at the end of the webinar. Our format will be about 45 minutes of content, and then the last 15 will be open for Q&A.
Perfect. Thanks for going through that. So we'll dive into first, just to make sure that everybody's on the same page. What are the different business structures you can have when you're starting and growing your business? And obviously, we're going to focus on incorporation today, since that's the topic, but it's a good starting place just to make sure that we know what the other ones are. So the most foundational one that you might be operating in without even knowing it, if you just started your business and you are going along doing your thing, is a sole proprietorship. So a sole proprietorship is just you, and then a partnership is when it's you and somebody else that have come together with the intention to start a business together for profit. So when you start either a sole proprietorship or a partnership, you have not created a separate legal entity in the eyes of the law. So that just means that you and your business are one and the same purpose or person for legal purposes. The benefits of this is that a sole proprietorship or a partnership is really easy and inexpensive to register. Like I said earlier, you might be operating as a sole proprietorship without even knowing it, even if you haven't registered your business. The other benefit is you keep all the profits. They just flow to you. But also debt is tied to you. Then there's something called unlimited liability, which means that you are fully liable for everything in your business because you are not separate from your business in the eyes of the law. This might seem reasonable when you are just operating as a one-person show, but if you're operating as a partnership, it also means that you're liable for any decisions that your partner makes on behalf of the partnership as well. So it's just something to think about when you're considering you're going into business with somebody and not registering a company, which we'll get into a little bit after. And then we're not going to spend a lot of time on this today. So if questions come up for you about sole proprietorships and partnerships, feel free to message either of us, but I'll flip it over to Alicia to talk about the tax consequences of being one of these entities.
Yeah. So, what happens when you have any business income that is sole proprietorship? It is directly tied to your personal tax return. So, you'll be familiar with that. The T1 general is your personal tax return. And then what happens is your personal tax just becomes a little bit more complex. There's an additional schedule, which is the business 2125. So, the business income is now added to your personal income. You may still have a T4 slip or you may still have rental income, but any profit that the business makes is now taxed at whatever your personal tax bracket is. So that is a big difference between sole proprietorships and then an incorporated company. Continuing on with sole proprietorships, like Jaime mentioned, it doesn't actually have to be registered. And this is a misunderstanding that I think a lot of people come to. Sometimes I hear people say, oh, well, I don't actually need to declare the income on my tax return until I'm making 30,000, right? And that is a misunderstanding. I think people are confusing GST registration with just income tax. So any amount of business income earned is taxable income. There's no dollar threshold that starts where it needs to be. Well, $1 would be the threshold where it needs to be included on your tax return. If you're running a business for profit, it needs to be on your tax return. And so even if you don't already have a CRA 9-digit business number, you may still have business income.
So we'll switch over to what it means to incorporate a company. So because this is why everybody's here. We're wondering what it is and when we should do it. So incorporating a company actually means that you're creating a separate legal entity from you in the eyes of the law. You're actually creating what the law considers a separate person. So this means that you are separate from your business. So the law and the government thinks, oh, hey, there's Jaime, and then there's Jaime's business. And that is what creates limited liability. So what this means, and is a key component as to considering whether you want to incorporate, is it important to you to limit your liability just to the company? And we'll talk about this a little bit later. But when we're talking about who owns a company, owners mean the shareholders of the company. And so when you incorporate a company, you create a bunch of different shares, which are ways that you can pay yourself in the company or declare dividends. Some of you might be familiar with that. We'll talk about that a little bit more later. But that's how we decide ownership in a company. Ownership, when you incorporate a company, is actually transferable, which is a benefit to a lot of people who are building a business that they maybe one day want to sell. And that can be a real reason why you want to incorporate a company. But the biggest thing you want to know about a company is that it creates a separate person in the eyes of the law.
Mm-hmm. And so if I can just jump in there, this separate person that is a company has its own tax return now. It's not part of your T1 general, your personal tax return. So when you're incorporated, you will now be filing two separate tax returns. You still have your personal tax return, but now the company itself has a separate corporate tax return that we call the T2 general. And there is a difference with a corp with you can choose what fiscal year end you want that company to be. So it can be any end of the month date. So for example, my company fiscal year end is June 30th. So my company year runs from July 1st to June 30th of every year. And I put this in the notes here that December 31st is not an ideal year-end date for a corporation. So that is, I think, it's really easy for people to wrap their mind around a calendar year. And so often when people are thinking about incorporation, that's just kind of where their mind goes, because it's easy to understand that December 31st is the end of the year. So the reason that I'm saying it's not an ideal year end is because of the timing of when your corporate tax return will be due. So CRA gives you a 6-month filing deadline from whatever you choose as your fiscal year end date. So if you choose December 31st as your year end, that means your corporate tax return must be filed by June 30th of the following year. The problem for me and for any other accountant that you're going to come across is that then overlaps with our busiest time of the year, which is March and April personal tax filings. So I love it when my clients take my feelings into consideration, which is, please don't give me more work to do when I'm already stressed out and working overtime. If you can choose something like June 30th or September 30th, then that helps to stagger the workload. And if it doesn't matter to you, then, defer to your accountant about what date they like. I personally, I love June 30th. I love September 30th, because then if you have any quarterly filing, like a quarterly GST, for example, it's still on the calendar quarters. So it's easier to wrap your mind around when your GST is due. But what that means is your accountant can get your corporate tax return done during the less busy time of year. It also helps us out for tax planning for the next year. So if we know by June 30th or September 30th what your business income is, then we can do a little bit of strategizing around how much of that business income do you want to declare as your personal income. And we're going to talk more about salary versus dividends on one of the future slides here. But we can have a little more control and flexibility over planning ahead for the next tax year if we give ourselves some more lead time to do that planning. So the next point here is the income must actually be withdrawn from the company in order to be included on your personal tax return. So you're withdrawing it in the form of either salary or dividends. Oh, and then I already said this, we have more flexibility with tax planning.
So the question that you're all here to have answered, when should I incorporate? Well, most frustrating answer we're going to give you is it depends. There are lots of reasons, which I'm sure you're finding out about why you might want to incorporate. But one of the myths that we want to kind of debunk, because I see this all the time in the online space, is business coaches or people with well-meaning advice give this magic number of when you hit six figures, it makes sense to incorporate. And that might not be true, or it could be true. But there are legal and financial reasons to consider. But I know Alicia has a point she wants to make on this as a rule of thumb.
Yeah, so people often want a number from me. And so what I tell people is if you are currently profiting less than $70,000, that is not an income level where I feel it makes sense, because the extra costs that are associated with running a corporation. So definitely there's higher accounting fees, there's higher legal fees. You might have higher insurance depending on like what kind of industry you're in. You may have other additional costs that are associated with it. Those extra costs are not going to be outweighed by the benefits if your profit is relatively low. So the biggest impact on tax savings is when you get into those higher income levels. So if I looked at somebody who was earning $150,000 of profit, and if they don't need all that money for their personal budget, then I would say, yes, this absolutely makes sense for a cost savings reason for you. But there's some more reasons that we will get into. But if you're looking for just like a rough rule of thumb, I always tell people less than 70,000, you're better off to stick with a sole proprietorship, because those extra costs are just going to eat up too much of really the money that you need to live on personally.
And it still depends.
Yeah.
Because there are legal reasons why you might want to incorporate your business from day zero. These are the conversations I always have with my clients when I get the intake form that says, I'm wondering if I should incorporate. So my first question to them is, are you in a risky industry? And I don't mean risky in the sense that there's absolutely a possible chance of risk. I mean, are you in a risky industry where there's likelihood of litigation or big debts? Like I consider construction, building, job site, anything with on-site work, risky. Healthcare, gyms, anything in food and beverage, to be honest. Daycares, anything with children, physical locations, or if you are a business that is going to immediately be hiring employees. So that is when I would say that would be a flag for me that incorporation from the beginning makes sense. There's also other reasons why people like to incorporate. For instance, I've had consultants or business coaches who I don't consider personally in risky industries say, I just want to incorporate because it's important to me to separate my personal from my business. And I am okay with that. Because that's a personal choice. And I say, you're not really in a risky industry unless you're doing some form of like engineering consulting might be, but there's also professional insurance for that. And insurance is a great way to manage that risk. And then the other part is if you're building to sell, like you have in your mind that you're building a business to sell, or you're needing to raise capital. So those would be some of the legal conversations I would have with the new client to say, let me learn about your business. Is it inherently risky? And is it important to you otherwise? If it's not, is it important to you otherwise to separate your personal liability? And if you're building to sell or need to do a funding round or something like that, probably a good idea to incorporate. I just want to look to the questions for a minute to see if any are applicable right now. Can you provide a definition for the profit you are referring to, Alicia?
Yes, thanks, Danielle. So I will give you a very simple equation. So profit is what we call the leftover earnings when you're taking sales from your customers minus all of the business related expenses. So the sales or the revenue is just the amount that you are collecting from your customers, and then any kind of overhead costs, advertising, website, office supplies, even things like your own vehicle mileage used, your own home office, those are all expenses that we would deduct from the sales revenue, and that final number equals profit. So you're only paying income taxes on the dollar amount that is profit.
Okay. And there's a GST question. I think maybe we'll come back to the GST question.
Yeah, let's leave that one for a little bit later.
Okay.
I'm going to answer this, and then I need to close my blind because the sun is
right.
Yeah. It's gotten so sunny today. It's like February 6th, but I'll do that after I...
We won't complain about that on the West Coast.
I know, it's good. It's not raining today. So from the financial side, the real big benefit of incorporation is when you get to the point that you don't need all the money that the business is making, and you can actually leave some cash behind in the corporation. So let's use a dollar example. So let's say that I was earning $150,000 of profit in the business, and I was incorporated, and for my personal budget to cover my mortgage or my rent and my groceries and shoes for my kids and all that stuff, let's say I only need $100,000 for my personal budget. If I am operating as an incorporation, my corporation pays tax on $150,000, but I can control how much Alicia Lowen, the individual, gets on her personal tax return. So by only paying myself $100,000, now personally, I'm in a lower tax bracket because I've only taken out the amount of money that I absolutely needed to, and I'm able to enjoy a very low corporate tax rate of, it's a flat 11%. I've got another slide that talks about this a little more, but 11% tax is way lower than any of the personal tax brackets, like unless you're in a super low income bracket. So that's the benefit of small business incorporation in Canada. If I was earning $150,000 as a sole proprietorship, I have no flexibility over controlling what my own earnings are. I have to pay tax on that $150,000 in the year that my sole proprietorship earned it, in whatever personal tax bracket I'm currently in. So we have a lot more flexibility over tax planning with the corporation. And so that's really when the big benefits come in.
Perfect. Do you want to close your blind?
I do. Yeah, I'm like, oh, I think this is more for me again. Give me just one
That's okay.
second here, folks.
This is probably what the next question is. How do I pay myself when I incorporate? I know that this is always something when I was deciding to incorporate my company, I was confused about whether I should take salary, whether it should be dividends. And that's when I leaned on the advice from my accountant. So Alicia, take it away.
Thank you. Oh, that's much better. That's how you know this is a live webinar and it's not, we're not robots and it's not pre-recorded. So yeah, I want to spend some time talking about the differences between salary and dividends, because this is the biggest change to running your business as a corporation. Is now you kind of have two roles in your company. You can be an employee of your company and you can pay yourself a salary just like you would any other employee. In that case, you're earning employment income and you'll get a T4 slip from your company. Like I, Alicia Lowen, can earn wages from Deximal Accounting Inc. I'll get a T4 slip from Deximal Accounting Inc. and that goes on my personal tax return. And I'll talk about the other points there in just a moment. The second option is to pay myself with dividends. So my second role in my company is as a shareholder. And so Jaime talked about how you set up the shares and that's how you can have control over paying yourself. So since you are the shareholder of the corporation, you can earn dividends, which is technically investment income. It's not employment income. You're being paid for your investment in this company that you have created. You've created a valuable company, and so the company rewards you with investment income as dividends. The difference there is dividends will be reported on a T5 slip. So any amount that gets paid to you from your company as a dividend, you'll get a T5. Now, this is where your accountant's role is really important because we have flexibility over this and we can control, but this is not like a one size fits all. It's not one type is better than the other type. There are a lot of factors that go into which one of these is best for your situation. So I always like to have a discussion with my clients and make sure that I understand a little more about their personal tax situation so that I can make a better recommendation. So yes, I see a question. Can you pay yourself both salary and dividends? Yes, absolutely. So the flexibility that we have here is you can do one or the other or both. You can do a high amount of salary and a low amount of dividends, for flexibility over what these amounts are and which type we choose. So the other differences are your salary is an expense for the business. So it actually reduces the profit. So earlier when I was saying your sales revenue minus your expenses equals the profit, and you pay tax on that profit number. The company could pay you a salary. That would be an expense. It would be a payroll expense for the company. Since that reduces the company's profit, you're going to reduce the amount of corporate income tax you have to pay. But in that scenario, you're kind of avoiding paying tax at the corporate level, but now you have a T4 on your personal tax returns. You're going to pay more personal income tax on your personal tax return. So you're not avoiding tax altogether. You're just kind of shifting it from you pay it personally there instead of the company. So the company gets a tax break. You personally have to pay more. The next thing is that your salary in the company is going to be CPP taxable. So Canada Pension Plan is forced government retirement savings. You're paying into CPP when you pay yourself salary. If I think most people in this webinar are currently operating as sole proprietorships. So if you are currently a sole proprietorship, all the money that you're making in your sole proprietorship, that is your personal taxable income, that is CPP taxable as well. And so right now you are paying CPP premiums on your sole proprietorship income. You may just not realize that you are paying it because it's just a line item on your personal tax return, the T1 general. It's part of that final number. Like when you get your tax return back from your accountant, I always like to split it up for my clients and be like, your final balance owing is 13,000, and that's coming from 9,000 personal tax plus 4,000 of CPP, because that number for sole proprietorships, people are often surprised at how high that number is, and they think 13,000, like that's so much tax. Why? I put it in a tax calculator, and the tax calculator or ChatGPT told me it would only be this much. Like this accountant must be kooky. No, what's actually happening is that final number on your T1 general is a combination of both personal tax and CPP premiums. So if I can just jump over. Yeah, please, Jaime.
Can I just say something? I also just want everyone to know that this was news to me. Like we don't learn this stuff. And so when Alicia and I were going through these slides, we had a big conversation and I was like, I really want to make sure I'm earning CPP. She's like, well, you are. And I'm like, well, one of my businesses I just recently incorporated and wanted to put myself on salary for the benefit of CPP. And she's like, well, you're already paying into it. So that was news to me. So we're all learning here as we go through this.
We are all learning. I've been in business for 10 years now, and I'm still learning new things all the time. That I'm like, oh, well, put that one in the bank for next time. But I know how to do that. So that's life as an entrepreneur. So the difference with paying yourself dividends, there is an opportunity for cash savings here, significant cash savings, because dividends, since they're considered investment income and not employment income, dividends are not CPP insurable. So they are CPP exempt. You can avoid having to pay CPP by only paying yourself dividends. So if you were somebody that was like, I don't care about having CPP when I turn 65, I've got RRSPs, I've got TFSAs, I have whatever, I own a condo that I'm renting out, I have another plan for my retirement income. I'm not at all going to be reliant upon receiving CPP benefits in old age, because remember, paying in to CPP is not necessarily like a bad thing. Like, yes, it's cash out the door today, but the whole reason is that it's meant to be a government pension plan for, self-employed people like us who don't have pension through work. When you turn 65, you will start receiving a CPP benefit check each month. Right now, it's about $1,000 per month at the maximum. So nobody's retiring off $1,000 a month. Like, you do need to have other savings for your retirement. But if you were somebody that was like, I would rather not have to pay into CPP today because I don't care about getting it later, I would say to that person, your strategy should be just pay yourself with dividends, because it's actually over $8,000 per year. That is the maximum of CPP, that you would just be able to avoid that by paying yourself with dividends. So that's a huge difference between a sole proprietorship business that you have right now. You don't have the option to opt out of CPP. If you're in a sole proprietorship, you're paying it. So that is an option for you with a corporation, to choose to pay yourself dividends and avoid paying over $8,000 of CPP. There is still no EI, so I do just want to clarify that today. If you are a self-employed sole proprietorship, or if you are a self-employed incorporation, whether you're paying yourself salary dividends in a corporation, doesn't matter. The default of all of those is you are not EI, employment insurance. You are not EI insurable because you're the owner of the business. You have to opt in to EI as a self-employed person. So it does not happen by accident. If you have not submitted the application, you're not in it. And that is also something that comes up a lot with new clients of mine, is people might think that they're still eligible for EI, but they became self-employed at some point along the road, or they became incorporated and they never opted in. Then you're not eligible for EI. You have to opt into it. Now, I also want to mention that there's a difference between salary and dividends for how it affects your RRSP contribution room. So if you are familiar with getting your notice of assessment after your taxes are done, there'll be a number on there that says This is your RRSP contribution room, meaning this is the maximum amount of savings that you can invest in an RRSP. And when you put that money in to an RRSP, you're getting that as a direct deduction on your tax return. Like you put $1,000 into your RSP, now your income is $1,000 less on that tax return. Like it's a direct dollar for dollar. It's a great tax return credit that you get. But there's a dollar limit to it. So if you were very financially successful and you're at the point in your life where you have your RSP room completely maxed out, you were able to stuff a whole bunch of cash in there, amazing. Now, what I would say to that person is, in your corporation, you are going to want to pay yourself with some salary, because salary is the only type of income that's going to keep increasing that contribution room limit so that you can keep investing savings in an RSP. If that's not your scenario, if you're like, I still have lots of room in my RSP and I'm not really at a point in my life where I'm able to put a ton of cash savings in there, to that person, I would say you would probably be better off paying yourself with either 100% dividends or maybe just a larger portion of your income as dividends, because you don't need to be increasing that RSP contribution room limit right now, and dividends are not going to increase that limit. So pay yourself the dividends now so that maybe you get some cash savings now, and then when your income is a little higher, you can put more money into the RSP savings.
And I think it's a great, sorry, I was just going to say, I think it's a great leeway into, or segue into saying all of this goes hand in hand with excellent financial planning, which is definitely outside my scope. And there's other options for financial planning too, but it just shows how important having an accountant who understands all this is.
And I love working directly with financial planners. Like, that's not my role, right? I'm not the one who's going to be able to tell you where to invest your money. But if you have a good financial planner, I like to have communication with them. You know, we can chat about, oh, should we do this? Should we do this? Like, that's how you can have a whole team of professionals that are supporting you. And then,
I think we should, sorry.
Can I just say HSA? Yeah. I know there's so much content just on this one slide, but I just want to say HSA because that is a super hot tax tip that I always love to recommend to people. So HSA is a healthcare spending account. This is a type of benefits plan. So now if you're self-employed, if you no longer have medical dental benefits that, or you don't have a spouse that has medical dental benefits that are covering you and any dependents that you have, as a self-employed person with a corporation, you can qualify for an HSA benefits plan, which is something that I love for like consultant type, you know, single owner corps, because what happens is you're able to take your medical and dental expenses and turn them into a 100% tax deductible business write-off. So your business pays for the medical dental when you submit a reimbursement expense, and the money comes back to you personally, just like any other kind of benefits plan. But it is a way that you can cover those medical dental costs from your business account. So definitely,
I'm glad you slipped that in.
Yeah, it's a really good. It's a really good point. I'm like, my kids are going to need braces someday, and that money is going to completely come out of my business and be a 100% tax write-off.
Wow, that's amazing. I also didn't know about that.
Yeah.
So how, Alicia, might incorporating save you some tax?
I would love to tell you all about it. Okay, I'll try not to get stuck on this slide for too long because I know it's super dry. I put this amount here just to call that out. So on the last slide, I was talking about CPP. So just to give you the dollar figure here, if you are currently a sole proprietorship and you are earning $81,200, that is where the maximum level of CPP is. So if you're 81, if you're 90, 100,000, you are currently paying $8,860.20 in CPP premiums. So that is immediate cash savings that you can achieve by incorporating and paying yourself 100% with dividends. Now, that's not the only factor, right? So like, yes, back to our legal disclaimer that Jaime so kindly gave us, like there's other things to consider, But this is kind of, I feel like, the thing that just smacks you in the face, that it's like, you are paying that much. Some people are like,
Tasha has a question. Is that net or gross income? That 81,000, is that net or gross?
net. So net profit.
Yeah.
Gross income, I would call sales revenue. And I know, like, we accountants get so silly. Like, why do we have so many terms that all mean the same thing? Sales, revenue, gross income. Like, why are we calling it three different things? But no, I'm talking net. So I'm just talking profit of 81,200.
Yeah.
That's what your CPP is on. What else do I want to say here? So if you are at a higher income level, you may not need to withdraw all of the company earnings. So, like that example I gave, if you can leave cash behind in the corporation, you are only paying 11%. So it is just like, in personal tax, we have these short ranges where it's like this tax bracket, then that tax bracket, then the next one. With a corporation, it's just one big old tax bracket. It's $0 to $500,000 of profit. So if your company makes anywhere in that range, you could be making $499,000 of profit, and you're only paying 11% corporate tax on that money. It's slightly more complicated if you have investment income, but let's just say it's just active income that your business is making. That is like a huge advantage for higher income people to save a lot of money having a corporation. So if you can leave the cash behind in the business, then you're not paying personal tax on it. You're only paying personal tax on what you withdraw from the business. So my tip here, some practical advice, if you want to kind of have a good mix of everything, I would say go for a low salary amount and a high dividend. So if you did something like a $20,000 salary, you'd be able to get that HSA plan. You'd be able to pay something into CPP, but not too much. You do a larger dividend, you're getting the tax savings of lower personal tax rate on the dividend. So that would be just a general strategy without like digging into somebody's particulars that I would often recommend. And one final point, it is possible that you could split income of the business with your spouse as long as the spouse is actually doing something. Now, maybe Jaime could comment on that, because we certainly don't want to have situations where spouses are being set up as employees, but they don't actually have a meaningful role in the business.
Yeah, I added the word meaningfully because I see this a lot with people who incorporate themselves, where they issue a class of shares, maybe just one class of share they've created, and issue themselves more than their spouse, but they still issue their spouse some shares. And when I ask why they did it, it's because of income splitting. They heard there's a tax benefit. And that used to be a thing that was more widely acceptable, and CRA didn't go hunting for that, from what I understand, Alicia, but now they are looking for that.
Yeah.
And so income splitting isn't a thing. And when I say meaningfully, I don't mean picking up your mail. I don't mean dropping off a FedEx package or like helping with admin. If CRA comes auditing the business, from my perspective, and this is more financial in the CRA world, but you want to be able to show that they did something meaningfully. And I wish I could say there's like a for sure definition that you pass or fail on this, but they're going to look at the business as a whole.
I totally agree. Yeah. Like, and I see this, like, sometimes people trying to be a little bit sneaky about this. And I feel like my role is to advise them to not be doing anything stupid that is going to get them in trouble with CRA.
Yeah.
So like, if you have some kind of professional designation, like you're an engineer, and then you want to bring your spouse into the company and you want to split your engineering professional income 50-50 with your spouse, but they don't have the same certification that you do, no, that's never going to fly. Like, you could maybe pay your spouse a $15,000 salary for the part-time work that they do, but you're going to need to have timesheets. You're going to need to have records of what the work is that that person is doing. It can't just be willy-nilly. So this is absolutely an area that CRA has enforced more so in the last few years, and are getting stricter about this. So I see a question that's relevant here from Tasha saying, can you income split as a sole proprietor? No. You are the sole proprietor. You are the individual. You are the one doing that work, and that work goes on your tax return and not your spouse's tax return.
Remember, as a sole proprietorship, you're just your business. Only under a company do you split ownership and can employ people. If you were to income split as a sole proprietor, the only way you could do it is if you hired them as a contractor in your business or an employee in your business. And there was a contract, and that would just be registered as an expense, and they would collect it as income in their business.
As a self-employed
Not as income
contractor.
Yeah, as a self-employed contractor. So it's no, you can't income split. And there's a question here. Good question.
Yeah, thank you.
What are the costs of corporation? Well, we're getting there right now.
Yes, we are. Skip ahead.
Oh, small business. Yeah, I think we've gone through the small business corporate tax rate that was on the last slide.
Yes, I said 500,000. It's 11%. And one strategy is if your business is earning more than $500,000, great, amazing. I'm happy for you. That's not a bad problem to have. You could do a strategy of giving yourself a year-end salary bonus in order to bring the income down below $500,000. But that could be.
That's more into a separate call.
Yeah, we would all love to have that problem, right? So
let's go through the cost of incorporation, because this addresses one of the questions from Amber in the chat. So as Alicia mentioned earlier, it increases your legal and accounting fees. And sorry, I can't see a slide on my side. So from a legal perspective, there's the cost of incorporation, which is in British Columbia, $351.50 plus a name registration fee, which is $31.50. To incorporate a company, there are a bunch of options. You can incorporate it yourself, which costs you just the registration fee. I know there's platforms out there that help you incorporate it. And then you can obviously work with a lawyer. I like to be pretty transparent with my fees. I start at $1,800 for my legal fee for incorporation as of today's date of Feb 6th. And that's an uncomplicated company, which includes the registration fees and the naming fee. So I like to do flat rate. But then every year you have something called an annual return, which is separate from your tax return, which is a nominal fee that you pay to let the province of BC know that your business is still operating. And if you don't file this annual filing, then they can dissolve your company after 2 years of missing your filing. So it's just something extra administratively. Typically, when I incorporate companies for my clients, they want me to do that filing for them. And then also at the time when we do the filing, we update their minute book, which is the corporate records book. And we create a bunch of resolutions and minutes and things like that that document what the company needs to document every year. So, and that I charge a flat fee for approximately $400 a year. So there are like fees. You can avoid them by doing it yourself, but I typically recommend you're at a webinar where you have an accountant and lawyer who are hoping that you're doing things properly. And this week alone, I've had 3 people come to me because they've issued their shares wrong, and now they're in a dividend tax mess. So for all the reasons that we just talked about. So if you're at a point where you're making that profit, I do encourage you to seek advice on it. We all don't know how these things work. Like I said, I'm learning along the way. And then there can be other fees that stack up at the time you incorporate. And I don't want to get into the complexity of what these are today, but when you have started your business as a sole proprietorship and you're moving it to a company, there's certain things that might trigger in the eyes of the government and CRA, it's acting as a sale. You're selling your personal business to a new company, and that can trigger a tax consequence. So there are workarounds for this, which I'm always attuned to. But there can be ways to defer taxes. And these are called rollovers if you're familiar with the term. If not, it's just something to flag with a lawyer, or something to flag that might make you work with a lawyer or an accountant before you go ahead and incorporate yourself. And I just want to be conscious of the time. So we're at 45 minutes. So I'll let you, Alicia, take over from here, and then we'll whip through the rest and get to the rest of the questions if there's any. Yeah.
Yes. Yeah. So to recap, Jaime said that it would be at least $1,800 up front and then $400 per year for the legal fees. I can give you my accounting rate. So if I'm doing the annual corporate tax return, I charge $2,750. So that versus a sole proprietorship annual tax return, I would charge $650. So those are my rates. Yeah. Also, as of today, February 6, 2026, there's a big difference. And so that's why earlier on I said, if you're profiting less than 70,000, these extra costs are not really going to outweigh the benefits that you're going to get, right? Because if you are only making 35,000, then the difference of paying to legal and accounting is going to just eat up too much of what you need for your own personal budget. And then you'd still have your own personal tax return to do. But I do want to mention what Jaime was saying here. I just want to give you kind of like a one sentence test. If your sole proprietorship currently owns equipment, so if you have a vehicle that is owned by your sole proprietorship, if you have any, definitely a building or any large tools and pieces of equipment, so a tractor or any other kind of stuff, like if you have a contracting business, lots of tools are more expensive. That would be considered part of the capital assets. If your sole proprietorship owns any of those things, what you'll need is to definitely have an accountant and lawyer work on the Section 85 rollover. We're not going to get into those details, but you just need to know if your answer is yes to that question, you should not be doing a DIY incorporation, because these assets need to be sold to the new corporation without triggering a capital gains tax for yourself. So that's not a situation that you want to DIY. That's all I'll say about that. And then it is also really important that now that you're going to be incorporated, your business has solid bookkeeping. You have to have separate bank accounts and credit card accounts in the business name. You cannot be using a personal account. You cannot be using a personal credit card. And at this point, a spreadsheet is not going to cut it. So for a lot of my sole proprietorship clients, they have very low transaction volume. It's a super straightforward company. In that case, using a spreadsheet to just track your basic bookkeeping, I need to get totals for my expenses, that's perfectly fine. But the reporting requirements for CRA, for your corporate tax return, are much more detailed, and we can't get the information that we need from a spreadsheet. So you've got to be using some kind of bookkeeping software. My personal preference is QuickBooks Online, but there's other good options as well.
Oop, we missed one.
Too far, sorry. Go back
That's
one.
okay.
Steps to incorporate.
Yeah, so we've gone through a lot of information today, but I just want, if you're thinking, yes, it's time to incorporate, or I'm not sure if it's in time to incorporate, but I want to know, like, what does the game plan look like? Like we said, like, get legal and accounting advice first, or at least book a consult. I know I offer 15 minutes free consults about this, and we can cover a lot in that time frame. And I know most lawyers would offer the similar situation depending on where you are. So just start by getting good advice. Speak to your accountant. You should, if you're thinking about incorporating, it's time to onboard an accountant, and getting their advice, and somebody who understands online business or the business that you're in is important. And I always tell this to people, but like, your accountant and your lawyer you should consider them part of your team. So interview them that way. Make sure that you like to work with them. Make sure that they're speaking your language. Make sure that they understand the business that you're in. Too often we feel like we just have to hire the person who accepts us, and that's just not the case. So you want to make sure you're interviewing these people think of them as part of your team.
Yeah.
To incorporate legally, you need to, if you're not using a numbered company, you need to have a name reservation search done through BC registries. And this is hard to pass because a lot of names are taken. And then on top of that, I recommend a trademark search. And do not spend money on branding or websites or anything until you know you can legally use a name. just broke someone's heart earlier this week about that. So don't invest until you know you can use your name, please. And then we go through, we set, if you hire me to do an incorporation for your lawyer, I typically check in with the accountant to make sure that we've set up a flexible share structure that will support your business as it grows and issue shares properly. And all of this takes, I can get a corporation done if everybody's responding, within a few days if we need to do that quickly. But it is nice to know, okay, we're aiming to have this done and have a couple weeks to work through it. But it can be done quickly. But it's nice to have a little space to make sure it's all done properly.
Yeah. And then the other things that need to happen after the incorporation is if you're in British Columbia, it's mandatory to have a WorkSafe BC account. So when you were a sole proprietorship, if it was just you as the only worker employee in the company, it was not mandatory. Now that you're going to be incorporated, it is. So I usually do that registration for new clients. We need to determine, does your business need a GST number, PST number? So depending on which province you're in and what your service is or product is, that's how we determine if that's going to be needed. And then potentially getting your books set up. I have seen situations where people are using, like, let's say it was QuickBooks Online, using something with their sole proprietorship, and then all they do is they just change the name and they keep on going with the same QuickBooks account. So I need to tell everybody that is not going to work. You are starting a new business from zero. It's got to be a brand new set of books. So even if you already have books, that set is going to close. You need to start a new company from day one. You're going to have a different 9-digit CRA business number. Your old 9-digit CRA business number will get shut down as part of this process. And then the last thing is, once you've got the new bank and credit card set up, I recommend going through your history of your current bills, anything that's on auto pay, like utilities or insurance, your cell phone bill. Make sure that all of those auto pay monthly costs are switched over to your new credit card that's in the incorporation name. And then once that's all done, you can shut down the sole prop bank account and shut down the old credit card and close the books in the sole prop. Okay, we are on to questions now, and I'm going to just start at the top of the chat and make sure that we have addressed the questions. We've got 8 minutes here, and then we will be closing right at 11. So Gilbelly asks, when would it be a good idea to register for GST on the Canadian side? Yeah, so GST HST, there is a threshold of $30,000. This is sales. So when we're talking about sales, I mean just the amount that is billed to your customers. If your business is under 30,000 in sales in the year, then it's not yet mandatory for you to register for a GST HST number. But if you're going to choose to not do it from day one, some people just do it from day one because they're like, I know that my business is going to have more than 30,000 in sales, so I'd rather just start that GST number on day one. If you're choosing not to, then you have to really closely keep an eye on that sales number. And what you're meant to do is reassess every calendar quarter. So it's not necessarily just January to December. You have to look at, okay, what was, let's say the quarter from July 1st to June 30th, I would have to look at my last, this is as a sole proprietorship, I'd have to look at my last 12 months to see if after this newest quarter, have I reached that threshold? That is the trigger where GST registration is now mandatory. And so you don't start charging GST HST until after you have an active number. This is a mistake that I see a lot. Sometimes people just start charging it because they think that they're supposed to, but they don't actually have an active number. Another thing that I see and people ask me is, well, what if I have a number, but then next year my sales dip down again and now my sales are 25,000? Then I don't have to keep charging it, right? That is not correct. So the 30,000, the only thing that that's used for is to trigger when registration is mandatory. Once you've registered, that 30,000 threshold is now irrelevant. You have a number, it's an active GST number. You need to keep charging it on everything. It doesn't matter if your sales go up or down. The threshold is just up to the point where you need to activate it. So hopefully that is a clear answer. KF asked, can you pay yourself both a salary and dividends? Yes, we answered that question. The answer is yes. We talked about the costs of the corporation.
There's an ask for financial advisors. Maybe I'll let Tasha connect with you separately outside for that.
I have some people I can recommend for that, Tasha. So you could just reach out to me, please. So my email is info@deximal.ca, and I can recommend someone for you. Absolutely happy to make an introduction.
Danielle has a great question, and I'm curious about this as well. Regarding the health savings account, or I think, HSA, if your spouse's benefits cover part of your healthcare expenses, can the company cover the remainder through the HSA benefit?
Yeah, absolutely. That's a great way to do it too, because a lot of other plans, they might only have 80% reimbursement, right? Like that's pretty typical with Sun Life or Blue Cross. So you can take the part that's your out-of-pocket cost, so like that remaining 20% that wasn't reimbursed, and you can submit that to your HSA. So how it works is the HSA is more of a pay-as-you-go type of plan. There's no monthly insurance premium cost like a more traditional benefits plan would be. So if you don't actually submit any receipts, you don't get charged for that month. So there's no ongoing cost. That's why I really like it for small corporations.
And it can apply to children and family members.
Yes, you cover your children. Yeah, so your spouse, yes, you cover your children. Yes, they would all be dependents under your HSA. And then when you submit the receipt, the benefits company charges a 10% admin fee. So that's how they're making the premium. So for example, if I submitted a receipt for $100, $110 would get charged to my business bank account. The benefits company would take their $10 off the top, and the 100 would go back to me as the employee, as my personal bank account. But in order to qualify for that, you have to be an employee of your corporation. So in that scenario, I'd say you have to pay yourself some salary. So don't go the 100% dividends route if you want to have an HSA. You need to have some salary to be officially on the books as an employee.
Leading to employee question, Kelly Ing asks, can you hire your teenager for, let's say, $4,000 a year for small admin work as a sole proprietor?
As long as they're actually doing work. Maybe you give more insight on that, Jaime.
Well, my question is for $4,000. Now you, as an employee, you have to register for CP. You have to set up a payroll.
You're going to have payroll deductions.
Payroll deductions. So I'm not sure if there's a better way. You certainly can, but you should paper it as usual. I'm going to tell you to have an employment agreement or a contractor agreement or something like that. I'm wondering if it makes sense. But yeah, you can. There's nothing stopping you, but just make sure you do it properly. It's all about making sure you've got receipts for CRA. Amber asks, is it smart to incorporate before you're even making money? I encourage you, Amber, to go back and listen to the beginning of this presentation. We covered this in a lot of detail. I'm a newer service-based business with expenses of $1,000 to $2,000 for the year and don't have any income yet. Go back and listen to the beginning of this presentation. We talk about the financial and the legal reasons why you might want to incorporate. And if it doesn't apply to you, then I'd probably encourage you just to stay as a sole proprietor. And then Nicole asks, would a medical related content creator be considered high risk? A business I'm involved with has a nurse and lactation consultant who creates online content and teaches newborn care classes. I'd want to talk to you in person about that. I can't tell you yes or no on your liability on that. But yeah, if you're giving, I think that's warrants a consult.
Advice. Yeah. I think it's important for everybody to know that you can start a business as a sole proprietorship and then incorporate later. And so that's what I did as well. And that's what Jaime did. Like, it's very common for people to start out as a sole proprietorship just because the barrier to entry is very low. Like, All it cost me to get started was a $40 name registration when I was a sole prop. But if you're kind of at the point where you're like, oh, I'm still working full time and I just want to start something on the side and see if it's going to turn into a viable business, then probably starting as a sole proprietorship just to kind of test it out is a good idea. But just be aware that I never recommend people do a DIY incorporation. I've just seen it go badly too many times. So like if you're ready to do that, get a consult from professionals that can help you.
Dana asks, how does and we'll take a few more minutes to finish answering these questions. It's 11 o'clock now. So if you have to log off, we appreciate it. We appreciate your patience with us rescheduling to Friday and hope you found some value. And we'll wrap up in a few minutes, but I think these questions are good ones. So we'll finish answering them.
Yep.
How does declaring income on personal tax returns work if you're in a partnership?
If it's officially a partnership, like both you and the other person are listed as partners when you registered like a sole proprietor general partnership, then the income of the business is split according to your ownership. So if there are two partners and it's 50-50, then the business schedule has the totals that the business earned. At the bottom of the business schedule, we list who are the owners, and we need to link those two people's tax returns together. So that is common. Like I do that all the time with people who have a 50-50 partnership with someone else. It doesn't have to be your spouse. It could be a friend, but then it's really a good idea to have the same accountant doing both people's tax returns so that they can coordinate those numbers.
Perfect. Tasha wants you to explain, I love that these are for you. Can you explain PST in more detail? Is it similar to collecting GST?
I can't give a short answer about PST. I will tell you, PST sucks. PST is the worst, and it is so complicated, and it doesn't make any sense. It's not a refundable sales tax, and the rules are like certain things are PST and certain things aren't. So I'm sorry, Tasha, I can't give you a short answer, but it's a good question.
But I will give you some personal advice on this, which is make sure that you are checking in with your accountant if at some point PST wasn't applicable on your services, and keep asking the question, because in my contract market business, PST wasn't applicable when I started the business. And then when the digital online space became a hot place to be, PST became applicable, but I didn't know that until about 4 years down the path. So I had a big PST bill to backdate. So it is something why it's important to work with an accountant in this case that understands your business and is keeping on top of stuff.
Yeah. In British Columbia, the PST rules are super complicated, and so it's not something that you need a consult, because it's not something that you're going to be able to quickly say yes or no. Let's move on to Yaroslav's question.
I don't specialize in construction contracts. That is a whole different beast. I can absolutely help with construction incorporation. Mm-hmm. Yeah.
Lyra says, can a person who has a corporation on dividends hire themselves as a contractor? No, sorry, that doesn't make any sense, because why would you be a contractor for a business that you are the owner? There's no advantage.
Jerry won't like that.
You're just making it more complicated than it needs to be. So if you own a corporation, you pay yourself with salary or with dividends.
Mm-hmm.
And maybe we need to just stop there. I see Danielle is saying PST is ugly, kettle of fish. Yes, that's right. I know there were a few bookkeepers who were on so I think anybody who's dealt with it is going to be familiar. It's a beast.
Amazing. Well, thank you so much for everybody showing up. And again, we are always available for more questions down the road if you want to contact us at our emails, or emails is better for me. I'm a DM girl for contracts market, but for my law firm, I like to keep everything for emails. And otherwise, we really hope you enjoy your weekend, and thank you so much for showing up.
Yeah, thanks. Hope you all enjoyed the webinar and got some useful insights. Have a great rest of your day. Bye.
Bye.